If you're new here, my name's Caroline and I'm on a mission to help women to manage their finances and to live more fulfilling lives. All right, so in today's video, I'm going to be talking about how to get onto the housing ladder. Now, this is something that a lot of people are really struggling with, particularly if you are a recent graduate, maybe you're fairly young, you're in your 20s, 30s, and you've got ambitions of living somewhere on your own, building some access to wealth, because often property is a stepladder to getting wealth, long-term wealth. So there are a number of ways that you can get onto the housing ladder, but first of all, you need to build a deposit. There are very few mortgages these days that are 100% mortgages. This is not 2008, 2007, 2006, where those type of mortgages were available. Now, there are some deals where you might find the mortgages are 100%, but those are going to be very few and far between, and the interest rate you're going to pay is going to be very high, and that's going to mean that your monthly payments are going to be equally very high. So it would almost be unaffordable for you. Never fear, there are some alternative ways to get onto the housing ladder. The first thing is make sure you know how much your deposit is, how much is your income, and where can you afford to live. Right, so number one, as I said, you need to make sure that you have a deposit. So how do you build a deposit? Well, think about it in the same way that you would build up savings. So do you need to take on extra shifts? Do you need to get a side hustle? Do you need to get like a second job? There are other ways that you can get extra income. Like, for example, if you rent a 2-bedroom property, then maybe you can get a lodger. And some of that money that you get from a lodger can be used towards your savings. If you're lucky and you've got the bank of mum and dad, then obviously that's another route to get onto the housing ladder, and quickly, because they've helped you with the deposit. But in the main, you will need to build up a deposit. So firstly, think about how much of a deposit are you going to need. Now, the size of the deposit you're going to need is going to depend on a couple of factors. Number one, how much is the property that you want to buy? The average UK property price is around £288,000, but let's just round it up to, let's say, 300,000, right? To make the maths a little bit easier. So usually you would need anywhere between a 5 and 10% deposit. So 10% would be 30,000, 5% would be half of that, so that's £15,000 that you would need to save as a deposit. So most lenders will have a loan to income ratio of somewhere between 3 times your income and 4.5 times your income if you're a couple. So let's say you're a couple in this scenario. If you're going to buy a house that is 300,000, your mortgage is 270, and you have a deposit of 30,000, then the income you would need is £60,000 between the two of you. So you're doing all right. So number one, to wrap up, another way that you can help towards increasing the speed at which you build your deposit is through a lifetime ISA. So a lifetime ISA is basically an individual savings account, but with the L at the beginning, which is essentially a scheme that has been running for a good few years. I want to say maybe between 5 and 10 years. And essentially what it means is that you can save money into an ISA or LISA, lifetime ISA, and you can save up to £4,000 a year, and the government will top up an extra 25%. So that's an extra £1,000 that you can build through the LISA. And the rules of the LISA are that you have to either be under the age of 39 or under the age of 40, or have opened it before the age of 39. And then also you can only use what's in the LISA to either buy your first home or use it towards your pension. So by the end of the year, if you saved in £4,000, you could have £5,000 at the end of the year. So that's just another great way of accelerating the speed at which you can build a deposit. It goes without saying that when you're trying to build a deposit, you're going to have to make some cutbacks and change the way in which you spend money. If you're pretty good with money and you have control of your finances, then great. If you're not, then you're going to need to think about how you can ensure that you are saving as optimally as possible. Don't deprive yourself to the point at which you're kind of miserable, but big ticket items like holidays, buying a car, do you really need one? Those are the kinds of things that will actually help towards actually building a deposit and not cutting out avocado toast and maybe like your weekly Starbucks or whatever it is. Now that you've built your deposit, let's have a think about what are the available schemes for you if you are trying to get onto the housing ladder as quickly as possible. So the UK government has a number of schemes that can help you get onto the housing ladder. The first of which is the Help to Buy scheme, or Help to Buy equity loan. And essentially what they do is that they give you a loan towards the cost of your property. So the loan is normally an equity loan. And I'll explain a little bit more about that in detail shortly. But basically, it's about 20 to 40% equity loan that you could be eligible for. It is usually only available on new build properties, and you yourself would only need to put in a 5% deposit because you're getting a loan. Essentially, it's interest free for about 5 years from the government. And because you only have to put down a 5% deposit, it makes it much easier to get onto the housing ladder, because otherwise you would spend many more years building an actual deposit. However, there are a few things you need to watch out for. So number one, it is an interest-free loan only for 5 years. Now, it might seem like a great deal, but actually after the 5 years, you start to pay interest at 1.78% as of the time of recording this video in September of 2024. This 1.78% increases every year in line with inflation. The loan repayment itself doesn't actually have a fixed period in which you need to pay it back, but you have to think about how you pay it back. And the reason is, one, as I said, you will start paying back the loan after 5 years at 1.78% plus inflation. And obviously, if you then go on to sell the property, you've still got this loan that you need to pay back. So if you've borrowed 40% of the property value, so let's say 40% of 300,000 in this scenario, that's £120,000 that you would need to either pay back as part of selling the property, or you just have to find the money somewhere, and that's a hell of a lot of money to find. And of course, that will be limiting on your ability to buy somewhere else, essentially, because you've still got this loan that you need to pay back. Then there is the shared ownership scheme, and this is something I have personal experience of, and I've made videos about this before, and I'll link it up here. So essentially, the shared ownership scheme, as the name might imply, is that you are buying a share of a property. So normally between 25%, sometimes you can do it as low as 15%, but normally it's about 25%, 50%, or 75% of a property. This one is a little bit less restrictive in the sense that you don't have to buy a new home. And if you buy, let's say 50% of the property, then 50% of the other half, you will have to pay a type of rent to the housing association usually, or like a non-profit housing agency is where you would normally pay the rent to. So you and them would own the property. The downside of the shared ownership scheme is that if you want to staircase, there are costs associated. So essentially, it's almost like you're buying again, right? So you've got your initial transaction charge, i.e. you would pay stamp duty maybe, depending on the value of the property. You pay your stamp duty, then you would pay your solicitor's fees, and you might actually have to pay some additional costs that the housing association may levy towards you. So you've got those, let's say, as an example, £2,000 off the bat every single time you want to staircase. And normally most people will staircase in tranches of 3. Obviously, if you start at 25%, so you'd have your initial charge at 25%, then you'd have your 50%, then you'd have your 75%, and then your 100%. So normally like in tranches of 3, right? So each time you would face these kind of like transaction costs, if you like. Then you would have to pay the additional charge that comes with the property price increasing. So let's say in an example, you start off with a property that is 300,000, you've bought 25%, or let's make it simple. Let's say you bought 50% of the property. Now let's fast forward 5 years from now, and the property is now worth 350,000. Well, the £50,000 increase, you and the housing association would have to share, right? So that's 50% of the profit, or the increase in value goes to you, and 25,000 of the increase in value goes to the housing association. So actually you've only got an additional £25,000 to buy the additional shares of the property. The other thing with a shared ownership scheme is that you are typically going to be responsible for most things within the property, because usually you'll be responsible for the things that are inside the property. Like, for example, if the boiler goes, there's a leak, there's, I don't know, something breaks inside the property, those are all going to be your responsibility. Most of the things on what they call the fabric of the building, i.e. let's say the roof, or the walls, or the windows, usually will be the responsibility of the housing association. And general things like safety, certificates, and all the rest of that sort of stuff will be the responsibility of the housing association. But everything else will be down to you. The other scheme is a first home scheme. Now this one is not as well known, but it offers new homes at a discount of about 30%, and it's usually only available to key workers. You're talking people like doctors and nurses, police, ambulance, basically people who work for the state. and you would also have to be a first time buyer. And also when you go to sell the property, you would be selling again at a 30% discount. So let's say you bought a house, it was 300,000, you got a discount of 30%, so £270. So 270,000 is how much you have paid for this property. When you go to sell it, and let's say it's now worth 330,000, well, there would have to be a discount applied for the next person that's coming to buy it. So you will always buy it at a discount and you will always sell it at a discount. The other scheme that I'll touch on quickly is buying your council home. And this is called the right to buy. This has probably been the government scheme that's been around the longest. And essentially, if you are a tenant inside a council house, or maybe you have a housing association property, you have something called the right to buy that property. You can exercise your right to buy this property at a discount. So to be eligible, you have to have been in your council property for about 3 years, and you must have a secure tenancy. The discount is roughly about £104,000 or £136,400 if you live in London. And I also believe if you're a member of the armed forces, you also have a right to buy as well. So this leads me now on to the scheme that is available for people who live in benefits. Now, I'm not saying that if you live in a council house, you will automatically be on benefits, but we do know that a lot of people who are on lower incomes will typically need to live in council housing. So you are definitely going to need a specialist lender. There's not many lenders that will consider mortgages for people who are on benefits, but a specialist broker can probably do that legwork for you to try and find the mortgage that's right for you. So you might want to consider something called a guarantor mortgage. Guarantor mortgages are available to quite a lot of people actually. You don't necessarily need to be on benefits to apply for one, but they make more sense in this scenario. And in essence, what a guarantor mortgage is that someone else, i.e. usually a parent, is guaranteeing that if you fail to make a payment towards the mortgage or fail to make several payments towards the mortgage, they will guarantee that they will make the payments on your behalf. Obviously, if somebody's guaranteeing your mortgage, you should be doubly sure to make sure that you pay your mortgage, because someone's putting their financial future on the line for you. So you really have to live up to your end of the bargain and make sure you pay that mortgage. So also check your benefit income, because some lenders will use that as an assessment towards whether or not they will lend to you. And finally, I know if you're on benefits, it's going to be quite hard to save towards a deposit, but every little helps. So if you're able to save, I don't know, £1,000, £2,000, £3,000, £4,000, however much you can save, all of it helps. Also, you will need to save for solicitors' costs too, so just bear that in mind. So even though you live in a council property or you are on benefits, most people who are on benefits are in work too. So there is extra income there that maybe you could find a way of saving some of it towards a deposit. Having a deposit is always going to be beneficial to you because your interest rates are going to be slightly lower, and it will make it more affordable for you to afford the mortgage payments. Now, I thought it would go without saying that you need to have a good credit score in order to access a decent interest rate on your mortgage, but I realize that not everybody knows this, so I'm going to cover this. And essentially what it means is that there are external agencies, usually credit agencies. The most obvious one of all is Experian in the UK, and Experian and companies like it will do a credit check on you, and the credit check will check whether or not you've paid your bills on time, how much debt do you have, are you on the electoral register, do you have county court judgments against you, and other things like that. So just make sure that all those things are kind of checked off. You can check your credit score for free. So search for free credit score and you will find lots of companies that will be able to tell you what your credit score is, and they will give you tips to try and improve it. I personally recommend going on to Money Saving Expert and search for their free credit report, sign up, and then you can see your credit report and also then take on the recommendations to improve that credit score. Now, if you are in a position where you've now built up a deposit and you don't need any of those government schemes, then some of the ways that you can afford maybe to get onto the housing ladder is by finding a fixer-upper. And usually the old adage of finding like the worst house on the best street usually proves to be fairly sound advice. So find a fixer-upper, fix it up, live in it, enjoy the home, and eventually, hopefully, you will see an appreciation on the property. right? Because you put in a lot of blood and sweat and tears, and hopefully you've done it right. You haven't done too much bodge DIY jobs, and essentially you should have a decent home, and you get it revalued, and then somebody will say your house was originally worth 300,000, it's now worth 400,000, ideal scenario. You can sell up and take that equity to go and buy a new home, or you can choose to just enjoy the fact that you have £100,000 of equity in your home. Think outside the box and think outside of your immediate area. So if you can't afford, as many of us cannot afford to live near our family, you're going to have to move further out. So have a think about places that are outside of, let's say, the main metropolitan cities like Manchester, Leeds, London. All those places you might have to think about moving further out in order to actually afford to buy a home. The final suggestion might be something that they call house hacking. And this is basically where you buy a property that has multiple rooms, essentially, that you can turn into accommodation. So you might want to think about it as a HMO, for example, but maybe you don't want to live in a house of multiple occupation, but this could be another way of just like building up extra savings or paying off your mortgage early. So if you buy a property that has multiple rooms, you can convert some of them into extra rooms. So for example, if you buy a 2 or 3 bedroom property, well, do you need the 1 and 2 extra bedroom? Maybe you do, maybe you don't. But maybe if you don't, you can rent those out to other people. So in the UK, if you rent a room out to somebody, you can earn up to £7,500 a year, and you could use that income towards paying off your mortgage early, or using it to go on holiday, or do whatever you want with that money. So if you found this video helpful, make sure you give it a thumbs up, share. Is there any advice that I've missed in this video? And how have you gotten onto the property ladder? Let me know in the comments below. Good luck on your home buying journey, and I'll see you for the next video.